Ladies and gentlemen, good day and welcome to the Q2 and FY'26 earnings conference call of Remus Pharma Ltd. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Purvangi Jain from Valorem Advisors. Thank you, and over to you, ma'am.
Good morning, everyone, and a very warm welcome to you all. My name is Purvangi Jain from Valorem Advisors. We represent the investor relations of Remus Pharma Ltd. On behalf of the company, I would like to thank you all for participating in today's earnings call for the first half of the financial year 2026. Before we begin, let me mention a quick cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's belief as well as assumptions made by and information currently available to the management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now let me introduce you to the management participating with us in today's earnings call and hand it over to them for their opening remarks. We have with us Mr. Arpit Shah, Managing Director, Ms. Anjali Shah, Chief Financial Officer. Without any delay, I request Ms. Anjali Shah to start with the financial highlights for the period under review, followed by operational highlights from Mr. Arpit Shah. Thank you, and over to you, ma'am.
Thank you, Purvangi, and good morning, everyone. We are pleased to welcome you all to the earnings call for the first half of the financial year 2026. So let me begin with the financial highlights for the period under review. On standalone basis for the first half year of financial year 2026, our revenue from operations stood at 47 crores, reflecting 24% of year-on-year growth. The operational EBITDA stood at 15 crores, marking 31% increase on year-on-year basis with EBITDA margins at 31.56%. The company reported a net profit of INR 12 crores, representing 31% year-on-year increase, and a PAT margin of 25.59%. Moving ahead on a consolidated basis, our revenue from operations stood at 400 crores, representing a 47% growth year-on-year basis. The operational EBITDA stood at 27 crores, up to 28% year-on-year basis, with an EBITDA margin of 6.75%. The net profit for the period was at 22 crores, a 21% increase year-on-year basis, and a PAT margin of 5.4 crores. Along with that, our PAT after minority interest stands at 17.5 crores, marking a 34% increase year-on-year basis. Now, I would like our Managing Director to give you some insights on our operational highlights for the period under review. Thank you, and over to you, sir.
Thank you, Anjali, and good morning, everyone. I'm happy to share with you the performance highlights of our company. The first half of the financial year ending 2026 has been a period of solid progress and consistent execution for Remus Pharma Ltd. As we continue to strengthen our global presence and expand across B2B and B2C segments. At Remus, we take great pride in the fact that our pharmaceutical formulations today reach patients in more than 40 countries around the world. Over the years, we have built a truly global presence, but our strongest footprint has been Latin America, where we have not only achieved reach, but more importantly, on real trust among doctors and patients. What truly sets Remus apart is our ability to move fast. We have a proven track record of introducing new products in the market in record time, often gaining as a first mover advantage. This speed and precision comes from the strength of our research and development team and our deep experience in regulatory and compliance affairs. Today, more than 95% of our exports come from advanced and niche formulations. This includes tablets, injections, inhalers, soft gels, oral suspensions. Each one is developed with a single purpose in the mind to ensure safety, reliability, and effective care for the patient everywhere. Our growth has been powered by a robust network of B2B and B2C, along with institutional partnership with government tenders. And now those businesses are being carried out from our subsidiaries, which is helping us build our own brands, creating strong presence, having more connections directly to the health professionals, prescribers, doctors, and patients across the world. At Remus, our mission is simple: to deliver innovative healthcare solutions that make a meaningful difference and to do it with speed, trust, and excellence. During the period under review, our B2C business witnessed strong momentum, increasing from 4% to 13%, with B2B accounting for the remaining 87%. This shift reflects our growth focus on higher margin segments. As we are talking about H1 right now, our B2C business growth grew from 4% last year to 13% for H1. So we are still waiting for considerable growth from 13% to probably 18 to 20% before the end of this financial year. We continue to strengthen our international footprint and achieve several important milestones across the region. In Central America, we successfully participated in Nicaragua national tenders and secured 2 key products awards, further consolidating our presence in the important markets. In addition, we have entered Algerian market and initiated product registrations activities, a key step in expanding our presence in North Africa region. This region offers promising long-term opportunities. Along with Bolivia, our subsidiary Remus Pharma SRL delivered strong performance with successful commercial launch of several products. These launches strengthen our product offerings across key therapeutic areas including cardiovascular, hematology, neurology, and anti-infectives. We also marked a significant milestone with the launch of rivastigmine patches across multiple markets. This is the first time we have been introducing a new therapeutic segment where our portfolio has these patches being distributed, sold in several Latin American markets. This product is not only the only product that we have been in pipeline, but we are also working on patches, dermal patches for other therapeutic categories as well. During the period, we also secured 37 new approvals, further deepening our regulatory footprint in the ASEAN region and reinforcing our commitment to broad-based growth in emerging markets. Lastly, we are actively participating in national tenders across various countries, with submissions over 20 products per market. This reflects our continued focus on expanding access to our products and strengthening our participation in institutional business segment, which is government tenders. As we look ahead, we'll continue to strengthen both verticals, accelerate new product filings, and expand our presence in high-potential international markets. We are confident that our focused strategy will continue to drive sustainable growth and create long-term value for our shareholders. With this, we now would like to open floor for questions and answer sessions. Thank you, everyone.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Achal Jalan from Lotus Wealth. Please proceed.
Good morning. Am I audible?
Yeah, sure. Go for it, Asha.
Yeah, I just wanted to understand your strategy to be cost competitive in the market, because to give you an example, in the African Zazibona collaboration, the manufacturers have certain cost advantages from the government to improve their local manufacturing, leading to faster filing approvals as well an additional cost advantage of around 25%. So can you provide some clarity here?
Actually, not all countries have those capabilities of having an in-house manufacturing and be self-reliant on manufacturing of pharma products. But I'll consider it one of the countries I recently, a month back, I visited was Algeria, where what we have been doing, yes, they encourage a local manufacturing of the product there, but at the same point of time, a technical know-how is more important than any country who is manufacturing pharma products, for which what we have been doing is we are doing a tech transfer and a licensing deal with them, where every product that in future, if they manufacture it at their end, we get the royalties on the product that they sell. Along with that, we get a licensing fee and a know-how transfer as well. Out of 40 countries that we have been present, I think not more than 1 or 2 countries are currently encouraging their in-house manufacturing. At the same point of time, as we are at a very right spot, if I talk about India per se, is our people are trained and very much know how about how a medicine is manufactured, which again, if every other country would want to do an in-house manufacturing by themselves, they would have done it years before. So, considering the fact the price that you're saying that it is a cost benefit for them, it is always give and take. It is not about cost benefit. It is all about encouraging them to manufacture their in-house. But at the same point of time, for such countries, we have a very different strategy, which again gives us a lot of potential growth in doing the business.
So in African tendering, there is this first priority given to the African manufacturers. So anything specific around there?
Actually, as you could see, our portfolio and the regions of our presence is not Africa. It is more on the Latin America, Southeast Asia, and CIS. Of course, we have started filing products in African markets, and we have been doing a small sizable business in Africa. But those products are not supplied to the tenders. It is more focused on the private markets. Also, if you see a product portfolio of any tendering country in Africa, their products are Me Too, where basically, nothing costs more than a penny. And for us, our focus for our next roadmap on the product portfolio is more on the niche, rare molecules, where difficult to find very specialized molecules. So, talking about as you asked about the African markets, we don't do tenders in Africa because I know it is a cutthroat competition in terms of costing and pricing and everything. But again, our focus is always going to be the molecules that others don't make, or there is hardly any player in the market who has a first generic approval of those products.
So, as far as I understand, the private market over there is only around 20%. So how do you plan to cater to the rest of it?
Actually, as I said, Africa, from private market perspective, our product portfolio and the therapeutic categories that we are following, even if it's 20%, does not affect our plans of launching new products in the market, because you have two choices. One is you want to do tender and make very less gross margins, or you want to sell less but make higher gross margins on private market. So it is a mixed basket of our strategy when it comes to Africa. It is not just about doing the tender and focusing that is an 80% market on that. Even by selling 20% market products to this country, you can eventually make more margins than what you even make in tenders. So that's our strategy for African markets.
Okay, sir, just one last thing. So as far as I understand, we have a more of a B2B approach, like in a commodity place, where the margins are around 7-8%. So anything around there? So I just wanted to understand with this approach, how can we call it more of a niche market?
So talking about Africa per se, as we have around 35 products. So let me give you an example on that. We have 35 or 38 products coming out from Kenya, which again are our brands, and this is what we want to launch by next Q1 on those products. We're already making the plan next week on how we want to go ahead with that. Those products are all going to be on our brands, B2C, and very much, very specific to the therapeutic categories when we talk about Kenya and Uganda per se. So there we are looking at margins more than 60-70% on that. And as you asked me before also that there is only 20% of the market, but irrespective if it is 80% or 20% of the market, we're still making good margins on the products that we sell. Is what our focus is going to be. So I don't know where this 6%, 7%.
That's a
Concall. Okay, yeah. So that is a Concall. Sorry, my bad. So I was just focused on the African thing. But so that margin is a Concall of our subsidiary SP as well as Remus. So you would also have access to the numbers on the standalones as well. Thank you.
Okay, sir. So I just wanted to understand what could be our blended margin levels going forward. At present it is around 5%. So going forward, what can we look at it around?
So, Achal, just to give you a brief, that the 5% you're talking about is at the PAT level that is focused.
Yes, ma'am, at the PAT level.
Sorry?
Yes, I'm talking about the PAT level, ma'am.
Yeah, so at PAT level, as Mr. Arpit mentioned, that it is a mix of all the subsidiaries, the consolidation of all the subsidiaries. So as we are growing more towards our B2C market, the B2C subsidiaries, as well as we are setting up our new subsidiary for the clinical trial research services. So considering that, as we move ahead, we are more positive on our H2 that those subsidiaries which we have incorporated and will be operational and will be adding to our margin. So we are looking at a better percentage in future, with at least moving ahead to what is 5% now. I think we can move it to 8 to 10% is something that we are eyeing, but eventually we'll see how the operations add up and at what period they add up.
So Achal, this will complement the question you before asked us is, see, our roadmap and aggression is more on the B2C segment. So B2B is our legacy business, but at the same point of time to define our PAT level margins, what we are going to do is we are focusing more on B2C filings of the products. That will eventually give us more gross margins and a better EBITDA and PAT on that. Moreover, if you see, I just wanted to focus that last year we did a B2C of 4%, and every quarter even though we have to do 2 quarters of results, but every quarter we check where we are in terms of our B2C and all the numbers. So this year itself, this 6 months, there is a 9% growth on our B2C segment. So last year was 4. As we speak right now, 30th September is 13%. So in 6 months, we have grown 8%, and we are eyeing that again, the next 6 months on B2C will be at least 6 to 8% more on that. That is what our target is. So if you think the trend from B2B is shifting to B2C, where and that why we have been doing this is to have a potential growth on our PAT levels as well. As also just to conclude on your questions, you said why we are not pitching 80% of the market. I think my shareholders will be happy that I'm pitching something which is 20% but getting a better PAT levels on that. Thank you.
Yes, sir. And just one last thing. Like, are you confident with this percentage? Because we are in a trading business without the presence of manufacturing plants. Are you confident that we can reach this level in the upcoming quarters?
Yes. So I completely get where you're coming from, and you also have a set of investors to talk about us. Ajal, what we stand out differently is not just only about, we have a light asset model where it's not only about manufacturing, it's about what kind of products, what kind of IPs that we have created and what trademarks that we have created in the market matters a lot. So unless and just to give you a fair example, that what we have, what products we sell, all those proprietaries are ours. It is not about any other one's property. So those holds a lot of value when it comes to when we go in the market, be it our trademarks, be it our brands, or be it our sales channels. So since last 10 years, this is what we have built in. Even we had a manufacturing plant or not, that has not been a question for us. For us, it is about a brand awareness where people actually know who we are, what we do, and what kind of offerings we have in the market. We see a lot of Indian companies coming and going where their sole purpose is to sell and make money. We are here to create a brand and then make an asset for our company, and the shareholders. So that's what we stand out differently from others.
But sir, as far as I understand, we are relatively newer to these markets. So with IPs and trademarks, do you think that within a few quarters we'll be able to create that level of brand that we'll be able to reach those levels of margin?
Agreed. Yes, that is what the plan is. Already in the pipeline. We have been doing this, and we'll still continue doing this rigorously, where we build a strong brand presence, and that will absolutely work and help us improve the numbers. As again I said, I want to reiterate it, this is a Concall that you're looking at it. If you standalone perspective, you look out on a Remus numbers, you will get an idea of where we are going.
Okay, sir. Thank you so much.
No problem. Thank you so much. Have a good day.
Thank you. We take the next question from the line of Hitesh Agarwal from Seaberg Private Limited. Please proceed.
Yeah. Good morning to all of you. So my question is, we have been showing good growth in the Latin American countries of Bolivia, Guatemala, and Dominican Republic. So any other geographies or any other countries which you are specifically targeting for good growth in the next 3 to 4 years?
Okay. So we have been, as we said, that we have been doing 3 countries, which is Bolivia, Guatemala, and Ecuador. Dominican Republic and Chile are the ones on the cards, where we have been also looking at acquisition of portfolios of other products in the market, in the existing market. We are at a very interim level of seeing how we are going to have those operationals done, because we want to get into the business when we know that how the market is going to react on that. Yes, geographical locations, we have been working on Kenya. As I said, we are getting around 40 products registered here. So Kenya is something that we want to start on that, and Chile in Dominican Republic. So we're putting it for this year, this financial year, we are looking at 3 countries to add on our subsidiaries.
Okay. And sir, in terms of if you could give a guidance in terms of the revenue growth for the next 2 to 3 years, or any revenue target you have in your mind?
I think what we have been doing is we don't have a numbers to disclose on that, but if you've seen our growth trajectory, we'll be at par on those expectations when it comes to our previous quarters, what we have filed.
Okay, sir. And to the previous, you had mentioned in the previous answer that you are kind of eyeing from PAT margins of 5% to around improvement of 200 to 300 basis points. So this would be, if I could understand, this would be over a period of 2 to 3 years, or what should I assume?
Yeah, Anjali, go for it.
Yeah, so Nitish, just to answer your question, that as I mentioned, that it depends on a lot of operational factors, that how we are able to or when we are able to achieve those. But just to give you a brief, that this increase in PAT or maybe improvement in PAT is because of the growth in the business that Mr. Arpit mentioned earlier, that we are focusing more on B2C, which we have been mentioning earlier as well. So as we move ahead, we have already improved. We are already at 13% of our total revenues for B2C, and we are focusing on eyeing a better growth in that terms with our subsidiaries present now in those countries, and as well as the other subsidiaries also contributing and starting to get operational and adding to our margins. So probably it could be 1 to 2 years, or probably next 1 year. It all depends on the operational factors that we see moving ahead.
Okay. And madam, going ahead in the next 2 to 3 years, so you mentioned 13% of the business comes from B2C, and the rest would be, I assume, is coming from B2B. So going forward, what will this revenue split look like in the next 2 years or 3 years?
So Hitesh, I think considering at the pace that we are adding B2C in our portfolio, we look at that next, at least this year and a year to come after, we're looking at 20 to 25% of our B2C to be around 25% in next 1.5 years. That is what I can assure you on what we are doing right now.
Okay, sir. Okay. And just to understand, so if you could let me know, in B2C and B2B, what will be the kind of approximately difference in EBITDA margins as such for us?
So just to give you an idea, so on our emerging market portfolio, which is Remus standalone and our Bolivian Guatemalan subsidiary, so currently our B2B margin, which we have been presenting our numbers for past few years, our EBITDA margin is around 32 to 33%, which we continue that we will be in that range on the B2B side. And on the B2C side, as of now, we have initiated our revenues right now, which we are already looking 35% plus EBITDA. But since we have just penetrated into this market in this segment, we are looking to improve that further as we move ahead. So that will be adding a better EBITDA margin over the years.
Okay. And one last question. So whenever you enter a new country, so what is your typical strategy in terms of distribution and in terms of kind of developing a presence? If you could give a color on it.
Okay, so it says whichever countries we have entered, we have tasted the grounds and we have tested the grounds before going full-fledgedly in terms of our subsidiary. So whether you know or not, but I personally travel almost 180 days a year checking all the markets, see how the markets are looking at it. Even the new market which we recently started, I spent good 7-8 days in Algeria to know how the market is, how our products are going to react in the market, how market is going to accept our products, who are the sales channels, who are the strong sales channels, distributors. As we are doing B2B in Algeria, my agenda was to meet top distributors and wholesalers in the country, see how it goes, showing our portfolio, see which are the products, because every country has a different rules and regulations, the cost of registration, the wait period, the regulations and everything, and the price of selling as well. So all that put into consideration, it is always, of course, we look at the data, the numbers, the IQVIA, the IMS that we see. But unless and until I personally or someone from my team personally don't visit the country, we don't start working on that. So there's a lot of thorough due diligence that goes into it. I remember my day one when I started this company, it was in Latin America. I didn't know anything about how the market is, and now I'm exploring new markets. So Same strategy, maybe different protocols and standards, but that is how we introduce new markets under Remus.
Okay. Thank you, sir. Thank you. That's all from my side.
Thank you. Before we proceed with the next question, participants, in order to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Rahil from Sapphire Capital. Please proceed.
Hello. Good morning, sir. Can you hear me?
Yeah. Yes, sir.
Yes. Hi. So firstly, you only serve in these two categories, right? B2B and B2C.
And I would put a third category as institutional government supplies, which again, if routed through our subsidiaries, eventually B2C, but if routed through a distributor is B2B. And another of our subsidiaries, SP, which is into services and distribution both.
Okay. So, if one has to understand, is it, to simplify, can it be said that these two are the main categories which you serve in, B2B and B2C, or there's further bifurcation there? Because you said your EBITDA margins are 32 to 33% for B2B, correct? And in the region of 35% for B2C. So I'm trying to understand, why are your EBITDA margins at around 7% for the quarter and then the last year as well? So what's the disconnect here? I'm just not able to understand.
Yeah, so Rahul, just to give you a brief, the EBITDA margins which we discussed earlier were from our emerging market segment that I mentioned. So you can focus that number on our standalone business, which is basically into distribution of this finished formulations into LATAM and all other regions. On consolidated level, as Mr. Arpit mentioned, that we have our subsidiaries which are consolidating, and one of the subsidiaries is our US subsidiary, which is into RLD distribution. So RLD distribution business is more of a high volume business, which generally it is high volume, high ROE business. It does not add up to the EBITDA as you are focusing as compared to the Remus or emerging market standalone business. So there you are seeing that the average out the EBITDA is coming around 7%, but when we go ahead and categorize it between the emerging market, the RLD distribution, and the other small part of services, so at that time, if you see, the emerging markets are standing at an EBITDA margin of around 32-33% that I mentioned.
So is this US subsidiary suffering any losses or because it's dragging a lot, right, on the EBITDA? So what are your plans and strategies over there?
Yes. So US subsidiary, as I mentioned, it is into RLD distribution services. So RLD distribution is basically that they have been serving to all the big pharmaceutical conglomerates all over the world globally. So they have been providing those products into the distribution of RLDs for their study purpose, for their research purpose, for their development purpose. So generally over there, in this particular business model, the EBITDA margins are generally low. There are no losses that we are suffering, but generally when we look at the mix of the EBITDA we are getting from all the companies, it is comparatively low, whereas the turnover is comparatively higher. So it is more of a high ROE focused business because there is no capital involved or there is no other capital or fund infusion that is required. That is how the business model for SP is. Whereas on the emerging market, or I can say on the Remus standalone side, the model is different, which is if you see the revenues are just at 47 crores for the standalone business, but the margins are around 12 crores on PAT level, or I can say EBITDA level, it is around 15 crores, which is stagnant, or I can say it is growing. So it is because of the mix that you are looking at, and none of the subsidiaries like SP or Remus, there is no losses that are present over there right now.
I'll also want to add on this SP, which is our US subsidiary, is if you ever look it out on the numbers when where this category of RLDs that we do, we are in amongst top 3 providers of RLD, which is reference listed drugs. So you name any big MNC or a mid-size MNC, you will find that we give them those products to them from the US, be it India, be it China or other markets. So that is a very, as Anjali rightly said, there is a huge volume there. At the same point of time, our margins are with a lower margins. So there's two ways to look at our numbers: is emerging market and SP, our US subsidiary, which is solely into distribution model.
So what proportion of revenues is this US distribution business?
So roughly the proportion of revenue, I can say, is around 80% from the US
That's why you see the...
Yes.
Sorry, I did not catch that.
So overall, from the consolidated revenues, around 80% is from our US subsidiaries.
Okay, so that explains the lower margins on the console level. Okay. Any sort of... Yeah, please go ahead.
Right. Also want to add that whatever acquisition value that we did on acquiring our US subsidiary, Anjali, you can give some brief on this so that he has an idea on that.
Yeah. So just what Mr. Rapat was adding to that we acquired this subsidiary in 2024, and I think after that, since then we have been tracking the financials, and I can say that we have almost recovered 80 to 90% of our investment, what we had done through our profits. Those profits have already been earned and accrued to us. So that is the basic business model for the US subsidiary, which is how it is looking, that when you go from the standalone numbers to our consolidated numbers, you look at a change in the number because of the revenue mix and ultimately leading to the EBITDA mix from both the business segments.
Mm-hmm. Okay, so if I understand correctly, because you are focusing more on the B2C and in the emerging markets now, so as they offer higher margins, that's the reason you're expecting overall increase in the blended PAT margins as you move ahead, correct? Because US subsidiary business will, I believe, stay there as it is at this pace.
Yeah. So it is, and it will be growing gradually as we move ahead in the same, at a stable level. But what we are looking at is the addition in our PAT is through these additional operations that you correctly mentioned.
But then, do you think this 80% revenue which comes from US will, taper down, and the percentage will increase more towards the emerging markets in terms of revenue?
Both will grow at. So right, both are on revenues from our subsidiary as well as standalone. That trajectory is very different. So of course we want to grow both the businesses from the revenues perspective. So we see that both of them will grow. At what proportionate and what percentage is something that is not in our hands when you compare both our subsidiary and a standalone revenue on that. But as I said, we anticipate that both will grow at a pace that we have been growing since last H1, H2 or quarters that we do internally at our end.
Yeah, no, I'm not asking you for a guidance how much it will grow at percentage wise. I'm just saying as part of total revenue, correct? The US subsidiary is giving 80%. So do you think because you're focusing more on emerging that 80% will let's say become 70, 65 in coming years, and emerging will take a more share? Is that the idea?
We think we correct. So yeah, we think that emerging will increase, but again, that is what I said, that also on the US side will also increase, right? I'm not saying that will be stable right now. So emerging will increase, but at the same point of time, our US subsidiary revenues will also increase. So yes, if you say from 80, do you think emerging will be 25 or 30? Yes, I agree to it on that question.
Okay, perfect. That's all I wanted to know. Thank you so much. All the best.
Thank you.
Thank you. Before we proceed with the next question, a reminder to the participants, in order to ask a question, please press star and 1 on your touchtone telephone. We take the next question from the line of Raman KV from Sequent Investments. Please proceed.
Hi, sir. I just want to understand, with respect to the growth of the U.S. business, how much did we do in the first half, with respect to U.S. business versus the previous year first half? And how are we expecting the U.S. business to grow in future?
Yeah. So, just to answer your question, so earlier as I understand your question, it is about what proportion of revenues are coming from U.S. subsidiaries. So that, as I mentioned, that it is around 80% that we are currently, our revenues are coming from the U.S. entity, 80 something, and the remaining is from our emerging market, that is Remus and the other subsidiaries. And for the last previous H1 that you are talking about, the proportion was around 75 to 80% was from US itself, but overall the quantum was low. If I consider the SP revenues itself, so it has grown by almost 40% for SP standalone basis, the US business standalone basis from previous H1 to this H1 because of certain new geographies they have been entering into. They are tapping new markets, new customers where they are entering and starting the distribution business over there.
So can we expect this momentum to continue with respect to the U.S. business, or the main driver for this around 50% growth during the first half was introducing a new product? Hello?
It seems like
Hello?
the line for the management has got disconnected. Please stay connected till I rejoin the management. Ladies and gentlemen, due to time constraints, that was the last question for the day. On behalf of Remus Pharma Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.